So in this video, we're going to go through lecture 15, which is on bank reconciliation statement. So the purpose of studying this chapter is to keep track of the difference between the cash book balance and the bank statement balance. So obviously, when a business does banking transactions, such as issuing checks or even receiving checks, the amount at a particular time in the cash book will not be equal to the bank statement figure. So clearly these are caused by a few reasons, and one of them is what we call timing difference, or the differences can also be caused by errors either made in the cash book or in the bank statement. Okay, so the objective of this chapter is to keep track of the difference, or in other words, to reconcile the cash book balance to the bank statement balance. So bank reconciliation is a process of where we compare the bank balance in the cash book with our bank statement balance, which is provided by the bank. So to be clear, the cash book is prepared by the business. So for this chapter, we're only going to focus on the bank column of the cash book. Okay? So this bank column of the cash book, which is prepared by the business, will be compared with the bank statement, which is prepared by the bank. So we have to see where the differences are and reconcile. Okay, and normally this reconciliation should be carried out regularly. Usually it happens at the end of the month. So we do not do it every day because it's very time consuming. So normally what businesses do is that they carry out this reconciliation periodically at the end of every month, just to keep track of what are the figures. For example, you have entered an amount in the cash book, but the amount is not seen in the bank statement yet, right? So we want to know when these amounts would appear in the bank statement. So besides that, the purpose of carrying out reconciliation is also to detect any errors made in either the cash book or the bank statement. Okay, so what are the factors causing the differences between the cash book balance and the bank statement balance? So generally, these can be broken down into 4 categories. A, the transaction is recorded in the bank statement, but it's not recorded in the cash book yet. For example, a customer pays us money by transferring the funds directly into our bank statement, and we have not come to know about it yet until maybe one day when we check through our bank statement, we see the balance appearing in the bank statement. So only after that will we record in our cash book. Okay. Or it can also be the transaction is recorded in the cash book but not appearing in the bank statement yet. Or there could be error made either in the cash book or in the bank statement. Or there could be previous month's transactions that are appearing in the bank statement. So let's look at all these one by one. Okay. So A, transactions shown in the bank statement but not in the cash book. So there are a few terminologies that you have to be familiar with, right? So firstly, bank charges. So when we go to the bank, when you do a transaction in the bank will charge you a fee, right? These are actually service fees charged by the bank in helping you to do the transaction. So these fees would be immediately recorded in the bank statement when your transaction has been completed by the bank. So we have to go back to our office and record these charges in our cash book to keep up with the transaction in the bank statement. Okay, then you have dishonored check. So dishonored checks are where, when customers pay us by check and they don't have enough funds, so the check gets dishonored. So the bank statement is the one is going to record this first. dishonored checks are always detected by the bank statement, by the bank first. Hence, dishonored check will be recorded in the bank statement. So we have to update our cash book and record this dishonored check amount. Okay, then you have standing orders and direct debits. So standing orders and direct debit, they might seem the same, but there's a slight difference between them. But to start off with, standing orders and direct debits, they are payments made on behalf of the business by the bank, which means the bank deducts the money for us. So what is the difference between standing order and direct debit is that standing order is where the bank deducts a fixed amount every month. So say for example that the business owner bought a car, for example, on loan. So the installment is a fixed amount every month. So rather than paying the fixed amount every month, either by going to the bank or by performing the transaction, in the computer. So the business owner would write a letter, an instruction letter to the bank, giving the bank permission to automatically withdraw this fixed amount from the business bank account at a particular date. So usually it's at the end of the month. So what the business owner has to make sure is that there is sufficient money in the bank balance to withdraw this amount. So every month, throughout the period, the tenure of the loan. So for example, let's say the loan is for 3 years, for example. So 3 years is 36 months. So for 36 months, the bank will automatically withdraw money from the business's bank account based on the instruction given by the letter. So once the 36 months has completed, the bank will stop automatically withdrawing. So that's standing order. So standing order is valid for a certain period, okay, and the amount is fixed. Direct debit, on the other hand, is where the bank makes payment on behalf of the business and the amount is variable. So for example, let's say the business owner goes shopping and spends on whatever amount. So this spending amount will not be the same amount every time. So as the owner pays for whatever goods that he's purchasing, that amount will be debited to the bank account. Okay, so basically standing order, the amount is fixed and valid only for a certain amount of period. Direct debit, the amount is variable and can last as long as the owner wants it to be. Okay, so and then you have credit transfers. So credit transfer is where the business receives money, funds, which is credited directly into the business bank account. Okay, so next, transactions recorded in the cash book but not shown in the bank statement. So this is the opposite of what we just discussed. The one we discussed just now is where the transaction was recorded in the bank statement first, followed by the cash book. Here is where the transaction is recorded in the cash book first, followed by the bank statement. So such examples of these transactions are, firstly, uncredited deposits. So uncredited deposits are where the business collects payment from the customer in the form of a check, and the business owner records it in the cash book, but this amount is not seen in the bank statement yet. Reason: either the business owner has not gone to the bank to deposit the check, or the business owner might have gone to the bank to deposit the check and it is waiting to be cleared. It takes a few days for the bank to process this check. So during this time period, this transaction would have been seen appearing in the cash book but not in the bank statement yet. Okay. Then you have unpresented checks. So unpresented checks are where the business owner writes checks to make payments to people, and these have already been recorded on the credit side of the cash book, but not deducted in the bank statement yet. Reason, either the person whom we have given the check to has not gone to the bank to deposit the check, or they have gone to the bank, but it is waiting, this transaction is waiting to be processed. In either way, transactions of this type are where these transactions have been recorded in the cash book, but not recorded in the bank statement yet. Okay, then another reason causing the difference between the cash book and the bank statement figure is there could be errors made in either the cash book or the bank statement. So if it's an error made in the cash book, then the correction should be done in the cash book. So we'll come back to errors later on, because I'll show you some examples when I show a sample question. Okay. But well, just to discuss errors, for example, maybe a business owner would have recorded a particular amount in the check, say 1,000. So let's say the business owner writes a check to someone for 1,000. He's supposed to credit 1,000, to record the 1,000 on the credit side of the cash book, but unfortunately he recorded as maybe 900 for some reason. So in this case, the cash book has been under credited by 100. So since the 900 has already been recorded and we want to correct it to 1,000, so we just need to add another 100 on the credit column, on the credit side of the cash book, as an example. Okay. Or errors would have been made in the bank statement. So in this case, the business owner cannot correct the situation in the cash book because this error was made in the bank statement. So when the error is made in the bank statement, this error should be shown in the bank reconciliation statement later on. Okay, and then lastly, you'll have previous month's transactions appearing in this month's bank statement. So this refers to transactions relating to previous period, which is appearing now. So this kind of transactions should be completely ignored. Completely ignored, as we have already taken account of this in previous month's bank statement. Sorry, previous month's bank reconciliation. Okay, so now going back to the main objective, in this chapter, we find that the cash book balance and the bank statement balance differs. So our idea is to be able to reconcile where these differences are coming from. So in order to complete the entire process, there are a few steps to follow. Okay, so step one is we need to cancel off items which appear in both the cash book and the bank statement, because this is not what is causing the difference. Okay, so in doing so, we would compare the debit side of the cash book and the credit side of the bank statement, credit column of the bank statement. So just so we are clear, to record money received, we record on the debit side of the cash book. So when we refer to the bank statement, money received will be appearing on the credit side. That is because the bank statement is prepared by the bank, and the bank sees us as a creditor. When you deposit money into the bank is holding our money. So the bank will debit their own cash book and credit our account. So that's why for bank statement, credit indicates money received as opposite to the cash book. Okay, so we would compare all the items in the debit side of the cash book and see whether the same items appear in the bank statement. So in doing so, we would cancel off both the debit amount of the cash book and the credit amount in the bank statement. So similarly, we would do the same on the payment side. So for payment side of the cash book, we refer to the credit side. So all money recorded on the credit side of the cash book will be compared to the figures appearing in the debit side of the bank statement. And we would cancel them off too. Okay, so once these two steps are complete, we have successfully eliminated items which are not causing the difference. And we do nothing about it because these are not causing the difference. What we want to know is what are the items causing the difference. Okay, so then the next step is to classify what are the items causing the difference. So these come in two forms, whereby either the amounts appear in the bank statement but not appearing in the cash book yet. So here we should adjust the cash book, and this process is called updating the cash book. Okay, and then we need to take into account items which appear in the cash book but not appearing in the bank statement. Okay, so these amounts should be shown in the bank reconciliation statement. So that's the entire process. Okay, so in updating the cash book, what I've shown here is all the possible items that might appear in the updated cash book when we update them. Okay, so we start off with the balance brought down. Well, the balance brought down may sometimes appear on the credit side. Okay, okay, then if there's a credit transfer, we need to record on the debit side because the money has already been recorded on the credit side of the bank column, credit column of the bank statement, but not recorded on the debit side yet. Okay, so these are all the possible items. So this slide simply shows you on which side of the cash book that you have to record when you update the cash book. Okay, as for the bank reconciliation format, there are two formats which you can use to your choice. We can start with the balance as per bank statement and then add uncredited deposits, less unpresented checks, and then add or less the error depending on the type of error, and we would get the balance as per updated cash book. Okay, balance as per updated cash book. So this balance as per updated cash book is the final correct cash book balance, which should be reported in the statement of financial position. Now, alternatively, we can also follow this other format, which is a complete reverse of the first one. So the first one, we start with the bank statement and we end at the balance as per updated cash book. So in doing so, we add uncredited deposit and less unpresented check. So in the second format, everything is the reverse. Instead of adding, we less uncredited deposit. Instead of deducting, we add unpresented check. And whichever errors that we add here, we would have to less here. Okay, and whichever errors that we left in this format, we add in this format, and we will get the balance as per bank statement. Okay, that's all for this lecture. So I'll follow up with further examples of questions. Thank you.